Hello. Typically, I want to come on here and bring you information about home buying process, but today I wanted to do things a little bit differently. And I think working with a mortgage lender is just as important, if not more important, than working with a good agent because they do a lot of the behind the scenes that most people don't see or acknowledge. So it's important to have good relationships with lenders such as Spencer, who works with me all the time so that we can make sure that our clients are taken care of. There's not going to be any surprises the day of closing. We're able to tackle that stuff oftentimes without our clients even knowing about it, which really,
For sure.
I think, is one of the best things that we can do. So without further ado, we're going to get started and we're going to ask Spencer some tough questions so that she can make sure that you guys are the most educated when you're entering the home buying process. Okay, Spencer, when someone puts in an application with you, you like to meet with them in person a lot of the times, if at all possible.
Yep. We definitely got good at the on phone thing during COVID, but I'm definitely more like a hands on. I'm a very visual person. So when I'm talking numbers, I want them to see numbers.
Yeah, that's really important too. And we do a lot of the same things when we're pulling comps. We want to make sure that we can look at it with you and go line by line
Yeah.
to make sure that you understand it. And sometimes I feel like that's lost in translation when you're over the phone
Oh, yeah.
or you're distracted with your kids in the background or things like that. So it's really nice that you like to meet your clients in person and talk with them. And you're local here to the Black Hills. So
Yep.
that makes it so much easier for clients.
Absolutely.
So what would you tell a client that they need to bring with them when they're going to go over a loan application with you?
So if they can't bring it with them, they can always send it beforehand. Honestly, the like very first steps of like getting started on a mortgage is they're going to do an application. It's honestly like probably like 5-10 minutes. You just click through it online. Super easy, very generic questions, and they don't have to know the exact answers when they're doing it because I'm going to change it later anyway. But then to bring it with them, I usually say like pay stubs, W-2s, bank statements are like the big pieces I need. If they are self-employed, 2 years tax returns is going to be the big piece.
Yeah, I know that gets a lot of people sometimes about the self-employment, but
Yeah,
it's a regulation that you have to go through. It's not like you're just trying to dig into people's personal finances or anything like that. So I know
no,
that's a big concern we get a lot of the times on our end that we try to tackle before we even send someone into a mortgage lender.
yeah,
But
realistically, like I'm only looking at their numbers. I'm not looking for anything crazy. I'm like, this is what you told the government you make. It's what I have to tell the government you made.
yep, exactly. Okay, so next, explain to me the difference because a lot of people ask me, and I know I don't explain it as eloquently as you will. What is the difference between, say, a pre-qualification letter, pre-approved, fully underwritten? Because I know that's a foreign language to a lot of people.
For sure. Yeah, and that's actually like my favorite thing to kind of explain to like my clients is you can go to like pushbuttongetmortgage.com anywhere, whatever online website it may be, and they'll give you what's called a pre-qual. And basically what they're doing is they are just saying based off the numbers you typed in that you say you make and what you claim is your debt, which you may not know your exact debts on a monthly basis, then they'll just say like you're approved to X amount. They don't tell you what that payment's going to be. They don't tell you, like, you don't even know if that's a payment you're going to be comfortable with. They're just letting you know max amount based off those two generic numbers. This is how high the government will let you go. So I usually like err in caution, like that doesn't mean you're going to be comfortable with it. Doesn't mean you're actually even approved. Because there's a lot of just pieces that can pop up in the middle there.
I know for us, one thing that we saw was somebody had co-signed, and that was a $500 a month payment, which significantly impacted my client's ability to get the mortgage.
Absolutely.
And had they been working with a local lender and went further than just the pre-approved or pre-qualification process, they would have caught that right from the beginning.
Absolutely.
But
or
they
right
ended up not getting the home.
Yeah.
Yeah.
Oh gosh. And that's like worst case scenario.
Yeah.
Yeah, or like right now, most people don't have student loan payments because everything's in forbearance. Technically, we have to prove to the government that we have to put in like what's called an example payment of that student loan balance. So when people are going to these .coms, they're not counting their student loans because they're not paying them. But that does have to be included in your debt to income ratio when it comes to your qualifying.
Well, yeah, because eventually you're going to have to start paying those
Yes,
loans
whether
back.
they're either going to get forgiven, which good luck to you. But
Yeah.
if they don't, like that, we have to prove that you would be able to approve your mortgage plus that whatever that payment might be someday.
Right.
So a full pre-approval is basically just meaning that we have completely gone through your application, your credit, your debt to income ratios, and me as a local lender, I go through your budget and I'm going to sit with you and be like, just because the government says you're okay with a $2,500 mortgage doesn't mean you are. Like, what is your actual ideal monthly mortgage payment? So we can have you shopping for houses that are actually in your budget and not just houses that the government say you qualify for.
Yes.
When you're going to do a fully underwritten program, what that means is I've already sent your entire packet of all these documents I'm going to ask you for. I already sent it to an underwriter. They've approved it, sent it back to me, and you are like basically done.
We just have to for sure find the house and
Yep.
plug in the taxes and
Exactly.
we're
Yeah,
good to
but
go.
you've completely been
Yeah.
like gotten the green light from an underwriter. It's already been through the whole process.
Yeah. And I know that's one thing that I really liked, and one thing that made me want to work with you specifically as my preferred lender was that you go through people's budget with them.
Yeah.
So I know from my past getting mortgages, they were like, yeah, go to this. This is your high dollar amount. Well, they didn't take into account that I like to travel. And I wanted to make sure that there was money set aside for me to be able to live that lifestyle.
Mm-hmm.
Whereas a lot of lenders won't necessarily go over that with people. They'll just be like, oh, yep, this is what you can get, max it out, get this, and you kind of go a little bit more in depth with people to make sure that they can still afford their housing and their lifestyle.
Absolutely. And that's, I think, such an intricate part of this conversation. My business partner and I both come from finance backgrounds before we went into mortgage.
Yes.
That I know you have goals outside of a mortgage that are you want to spend your money on. So I want to know where's that comfort zone for you on what you're okay with being your house payment versus do you want to just spend 55% of your income on your mortgage because the government will let you do it.
Right.
So that's just such an uncomfortable conversation that if you're not sitting face to face with someone who's actually asking you those questions, you're not going to get those answers.
Right. No, I totally understand that. We're going to go off topic just a little bit here. But I know you also talk to people about budgets long term, even after the process. And that was something that really made me want to work with you even more. So, can you tell me a little bit more about the long term budget goals that you have for clients, whether you touch base with them 3 years after, 5 years after, whatever? What does that look like for you in your business?
Yeah. So I really, and we kind of joke about it. So mortgages is going to be 30 days, and then I'm going to hand you the biggest debt you've ever had in your life.
Yeah.
Ideally, for me, what I want to be is like your mortgage coach. I want to help you through the next 30 years of your life of how to actually make this something that's going to make you money someday. So realistically, what we do is we obviously check in to make sure you understand your payments, and then we do a yearly financial review. So we're going to sit down and make sure like you understand how much equity you've built in your home, you understand where you're at with your rate, and if it is time to refinance or do a HELOC or those other pieces, but also just how that tool is now going to be able to help you in retirement and those other pieces that other mortgage lenders are just like I said, they're going to give you the biggest debt you've ever had in your life and they're going to walk away.
One and done. That's it. And I say the same thing coming from the real estate side of it. Like, I don't want to just help you buy this house. I want to be like your realtor BFF for life.
Mhm.
I want to help you get into your next home or your investment properties going forward and things like that, which I think is why we're kind of on the same wavelength there as far as setting you guys up, clients in general, up for future success through real estate and home ownership.
Absolutely.
Can you tell me a success story that you had with a client? I know we talked about it at our last meeting where you called up a client who had recently got a lot of equity built up in their home because everybody knows what happened to house prices the last 2 years.
Goodness, especially around here.
Yeah. So they had a lot of equity built up in their home. Can you talk to us about what you did for that client to restructure their finances?
Yeah.
And combine that? I know we talked about it before, but
yeah. So we were actually watching. I don't remember if it was a podcast or who knows what I was listening to at the time, but credit card debt is at like an all-time national high.
Yeah.
And reserves, so like what people have in the bank, is at an all-time national low.
Mm-hmm.
So that just kind of got us thinking because we have so many people right now that are sitting, they got a 2.75 rate or 3.25. They're like, I'm never moving. Right. I'm never refinancing. You can't get me out of here. But this client of mine, and they're actually a friend, and they were just like, realistically, budget wise, like we're just so tight. Mm-hmm. And they're like, we'll never be able to move. And I was like, you're sitting on more equity than you've ever had in your life. Like, I don't know if you've been watching what the market's been doing, but they've had their home for a long time. So what we did is we just sat down and realistically looked at like what they were paying in interest on their credit cards and their cars and all these other debts versus what they were just paying on their tiny little mortgage. And I was like, man, let's look here. Let's do some just math. Because that's all this is it's just a puzzle. And that's my favorite part of it, is just doing the puzzle and making it fit for that client. But what we did is we rolled in all of their credit cards, both of their car loans, all of these pieces. we changed their mortgage payment by, I want to say like $300 a month, but we saved them about $1,700 a month in their budget. So yes, rate is important, and I don't want to like deter from that. But they went from a 3.25 rate on their tiny loan to, I want to say we went to like a 6, but they knocked out so much in their monthly budget. I'm like, man, now you have one mortgage and one student loan.
And they were probably
And we're
paying
done.
what, 20-some% on their
Insane.
credit cards, which also were probably not going to be paid off for 20 to 30 years anyways,
No.
which really, I mean, we've actually ourselves gotten into some financial debt with credit cards.
Mm-hmm.
And when you look at the big picture and you're like, oh my God, I'm never going to get these paid off, it's daunting. And there's honestly, when I did it, I didn't want to go to my parents and say, oh,
Yeah.
I screwed up, you know. But to have a lender like yourself where I would be able to come to you and be like, you know what, we screwed up.
Yeah.
What can we do to fix this? Like, I like that you let your clients know that they can feel comfortable enough to come to you, whether they're friends or not, because I know people who aren't even your friends are still great clients who will come to you and say, you know, I've kind of screwed up. How can we get around this? And I love that finance background that you have, you can actually help coach clients beyond just qualifying for a mortgage. So I think that's really, really important.
Yeah. And I mean, we preach to these people every day, like, this is the biggest investment you're ever going to make. This is actually a tool. I mean, for most people, what they own in real estate funds 60% of their retirement. So if they're not getting into the game now, so many people won't retire at all.
Right.
So just teaching them, like, this is a tool. You don't have to hold on to it forever. Use it. Like, use this tool that you own. And yeah, we completely changed their whole financial setup and really like set them up for a really strong retirement now.
That's awesome. I love that. Okay, so now we're going to talk about a topic nobody is comfortable with right now, and that's where the rates are in the market. So, can you talk to us about how you approach these higher interest rates and what we've been seeing, and ways that you can approach a loan program for your clients so that they're still getting into a really great mortgage?
For sure. So rates are always going to be rates. It's actually, I kind of tell my clients, I'm like, high rate market is the best for buyers because it means there's not as many people you're competing with. When you have rates that have done what they did in the last 2 years, that's when you're going to see buyers flood the market. You're going to see 17 people offering on one house, and you're going to see housing prices go through the roof. Whereas right now, when we have this higher rate market, we're seeing these houses sit on the market a little bit longer. You have a little bit, just time to think.
Yeah.
But B, you're not just competing with 17 people trying to get your market in. You're not offering over the asking price. So it really helps with that. What I don't think gets taught to people a lot is just how interest rates work and how fluid they really can be.
Right.
Well, like you and I have talked, like if you go online, you're going to see what's called the quoted rate.
Right.
And that's, for lack of a better, that's the sexy rate. That's the rate that mortgage lender is trying to put out there to make themselves look good. Everybody does it. My company does it. Everybody does that. But you don't, if you look down a little bit further, you're going to see that like fine print of this rate is with a 720 credit score, a 20% down payment, and with you paying what's called points.
Mm-hmm.
So points, for lack of a better term, it's 1 point is going to be 1% of your loan amount. So if it's a $500,000 home, that's an extra $5,000 you're paying to buy your interest rate down. Which, if that point is only taking you, let's say it's taking you from 6.5 to 6.25, and it's only saving you $80 a month, if you don't keep that mortgage for 63 months, you didn't even make that money back.
Right. So
you're not even breaking even. You got to kind of think of those points as like you're prepaying the interest.
Yeah.
It's nice to keep your payment low, but you really want to pay attention to that closing cost piece, which you pay attention to for your clients. I know you do, because that's how we ended up talking. But paying attention, like, what are you really paying for? Are you just paying prepaid interest to buy your rate down to get this sexy rate that they're offering?
Right.
Or right now, when we know mortgage rates may come down in 6 months, maybe it makes a little sense to just take the market rate, keep that money in your pocket, and then just refi later.
Well, and that's what I always tell my clients too, is I would much rather you shop in a higher rate scenario, because you can always go back to your mortgage lender whenever the rates come down and say, hey, can you refinance this for me? And guess what? They're going to refinance that for you at that lower rate.
Yep.
What you can't do is go back to that seller and be like, hey, Mr. Seller, I offered 40,000 over your asking price. Can you give me that back now that rates are more steady?
Yeah.
They're going to look at you like you're crazy.
Absolutely.
So that's why I always tell people, I'm like, don't be afraid of these higher interest rate markets, because really,
this is clearance time.
Yeah.
Like, this is when houses are normal.
Exactly. And I think what a lot of people forget too is historically, 6.5 is still pretty low.
Yeah.
I mean, I'm not old enough to be in the buying stage, but I do remember everybody talking about when interest rates were at 18% or more.
I've definitely talked to clients that have told me about that. And I'm like,
Yeah.
they were like, oh, the first time we bought our house, they're smitten with the fives or whatever it is at the time.
Yeah. So I think that's really important that people think about too, is that we still overall are at a fairly low interest rate.
Absolutely. And if you think of like where we live, you got to think of the house as the fixed cost. The rate is a variable. Like, don't get attached to your rate. Who cares? You can refi it anytime. The house is the fixed cost that you're going to end up spending. Either you're going to spend X amount on it this year, or you're going to spend who knows how much on that same house next year. The houses are not going to change, and that part is not, especially where we live, not going to go down, not going to slow down. So getting in now, even if it's a little higher interest rate, and then just fixing your rate later, is definitely going to save you so much more money in the long run.
Yeah, no, I completely agree. Was there anything else that you wanted to cover today?
I don't think so. I mean, you usually come with all your pre-questions. So, and we've talked about most. So I'm always here for the questions.
Great. Well, thanks so much for coming on. I'm so glad that we got to
Thank you for having
do
me.
this, and we'll have to do it again.
Absolutely.
All right.